Hello, friends and family and loyal clients of Wood Financial Group. Wes Wood here, President, and I'm excited to release this video as we roll into Memorial Day weekend. First of all, I hope you guys have a fantastic weekend to kick off the summer here with perhaps your family. Maybe you're going boating, perhaps going to the beach. Whatever you're doing, I hope you have just an awesome weekend to kick off this summer. But I wanted to release this video because the stock market is getting beat up. That's an understatement. The market is down. It's down about 17%. So I want to release this video to talk about probably how it's affecting your portfolio that we're managing for you. And if you came to us wanting to invest for income, we always talk about income. We always talk about chickens and eggs. You always hear about us say, hey, we only want you to eat your eggs, not your chickens, right? We don't like eating those chickens. So investing for income right now, what's happening with it? So what I want to do is go over a couple of sample portfolios. This is essentially real numbers here of what's happening to those portfolios compared to the stock market. So right now the stock market is down. So if you had $1 million at the beginning of the year invested directly into the S&P 500 stocks, your $1 million is now down to, call it $829,000. Now the S&P 500 does kick off some dividends through those common stocks that are within the 500 companies there. The dividends right now is about $15,000. But the growth model, the way that you really make money in the growth world is you buy it and you hold it and you don't liquidate. You've got plenty of time to recover from big corrections and crashes in the market. But as our concern is always for folks that are close to out or in retirement, you may not have the luxury of time to rebuild when you want to start using this money, correct? So what we've done with most of you guys is probably take you from the G to the I, from growth to income. So what's happening with those portfolios? So with a 100% non-insured blend being held at TD Ameritrade, being sub-advised by Sound Income Strategies, the portfolio is down in value. But one thing has remained the same. The interest and dividends that portfolio is kicking off. So yes, are those chickens skinnier? They are. But what has not changed is the interest and dividends, which is really, in our opinion, one of the most important things that we're worried about now is income. So right now, portfolio is down to about $912,000. So it's roughly half as much down as the S&P 500. The S&P is down about 17. These are down about 8.8% or so. But the income has remained the same. The interest and dividends and annual yield is staying the same. Annual yield on the S&P 500 is $15,000 of dividends. This portfolio is throwing off $53,000 in interest and dividends, which has remained the same. Now, could it change? Yes, this is non-insured vehicles that are inside of this portfolio. So could a company cut a dividend? Absolutely. Could a bond default? Absolutely. There is some risk here, but the point of the matter is that it is a much more conservative way of investing than just being pure stocks and in growth. So we probably took you from the G to the I, and if we went through that allocation with you and said, you know what, I just want all non-insured, that's probably what the $1 million is looking like right now. But the income has remained the same. Now, some of you guys said, no, I want to be more conservative. Maybe I want to have half of my money in non-insured areas, and I want to have half my money in insured areas that I know are not going to lose principal. So that particular portfolio, if you did a 50-50 blend, the million is down to $956,000. Because remember, the 50% that's insured has remained the same, hasn't lost a dime. The non-insured portion is still down the 8.8, but obviously it's half the money, so the whole portfolio value is down not as much as 100% non-insured. It's down to $956 compared to $829,000. So that's a difference of approximately $120,000 of principal that has been essentially protected because you went a little bit more of a conservative investment strategy compared to the S&P 500. So I'm really glad if you made the transition to more conservative investments, especially during these tough times in the market that we're seeing now. But the one thing that remains the same and has remained the same is those interest and dividends. And the importance of that. It could be that you're taking income out of your portfolio. Let's say you're taking $40,000 out of your portfolio. Remember, you only want to eat those eggs, not those chickens, right? So if you're taking $40,000 out of a portfolio, and if it were to be invested in pure growth, well, let's just do the math. Say you're generating $15,000 in interest and dividends. Those are the eggs that those chickens are producing, because yes, those stocks can generate some dividends, but you're taking $40,000 out from a withdrawal. So what's happening here? That's right, we're seeing principal being eaten up if it's heavily invested in growth in the G. Matter of fact, we're going to see $25,000 of shares having to be liquidated when they're down in value. And what could happen even worse is if the market continues dropping and you continue wanting to liquidate to get to your $40,000 because it's not generating enough eggs to cover those distributions, we're having to eat chickens. We don't want to eat chickens. As compared to an income portfolio that's throwing off $53,000 of interest and dividends. Say you want your $40,000. That's okay, because what's happening is you're still accumulating enough interest and dividends to actually be reinvested. Matter of fact, in this example, it's $13,000 of interest and dividends are able to be reinvested to buy more chickens. So remember, even though your portfolio may be down in value, the income has remained the same. We're not fretting over here at Wood Financial Group in the income model, because we know that as long as we're not liquidating now, we're just eating those eggs and not those chickens, it's going to be just fine. So thank you for tuning in. I hope that this video just gave you maybe a little bit more comfort going into the Memorial Day weekend. Obviously, if you have any questions, we're here to help. Give our offices a call. We'll be glad to answer any questions you may have about your portfolio. Maybe you want a reallocation change. Maybe at this point you want to make some shifts. Maybe you want to make some shifts from non-insured to insured with a portion of your money. Or perhaps you're saying, hey, I'm a little bit more optimistic here. I want to go from insured to non-insured. If you need to rebalance your portfolio, you wish to talk about it, just give us a buzz and we'll be glad to assist you with answering any of those questions. But hey, again, I hope you guys have a wonderful weekend. And if I don't talk to you much this summer, I hope you have a great summer. And we're here to help in good times and bad. Thank you, guys.